Good morning, everyone. Welcome to the first Webinar Wednesday of 2023. First National Bank Alaska is pleased to bring you Climbing the Fed's Ladder, presented by our special guest, Deborah Cunningham. My name is Laura Asghari, and I am a Wealth Management Officer here at First National Bank Alaska. I have been helping Alaskans with investment management and retirement planning for over 20 years. Nicole Kennedy and Everett McDowell are both wealth management officers specializing in trusts, estates, and financial planning. Both have over 20 years of experience. Kara Blake is our wealth management business support manager. On behalf of everyone at First National, thank you for joining us today. I would like to take a few minutes to share with you the services wealth management offers our bank customers. Trust services. As a corporate fiduciary, First National can be named in documents as trustee. This capacity requires the highest standard of ethics and responsibility. As such, we secure the intent of the trust writer while serving the diverse needs of our beneficiaries. First National can be named as a personal representative for your estate and navigate the legal complexities that come with large estates. Our wealth management officers have decades of experience working with beneficiaries, attorneys, and the courts, guiding the process of the estate settlement. Investment management services. First National Bank Alaska can manage your investment for you. Our Wealth Management Investment Committee uses their decades of experience to ensure our portfolios hold quality investments and stay aligned with our clients' needs. With our client-managed accounts, you direct the investment decisions, and we take care of trade execution, tax reporting, and account maintenance. Each of our wealth management experts are backed by First National's experienced board of directors and the Wealth Management Trust and Investment Committee. A lot has changed over the years, but one thing that remains consistent is First National's commitment to providing our customers valuable information on key topics. And that's why we have invited Deborah to speak with you today on liquidity markets. I have the pleasure of introducing our guest speaker, Debbie Cunningham. Debbie is the Chief Investment Officer of Global Liquidity Markets. She joined Federated Hermes in 1981 as performance analyst and has 35 years of investment experience. Since 1990, she has been a portfolio manager for all government and prime liquidity products. In 1994, she took over the management of the Taxable Liquidity Group. Debbie also oversees the management of the domestic tax-exempt liquidity portfolio, as well as the offshore liquidity products. Debbie is currently a member of the CFA Society of Pittsburgh and previously held the title of Director and President. She also serves as a board member for the Robert Morris University Treasury Market Practice Group and Depository Trust and Clearing Corporation. Debbie earned a bachelor's degree from Duquesne University and her MBA from Robert Morris University. She is also a CFA charter holder. Debbie was most recently recognized by Barron's as one of the 100 most influential women in U.S. finance. So just a few housekeeping items before I turn it over to Debbie. In order to avoid any disruptions, we have muted everyone's microphone and turned off videos. We will take some questions at the end of the presentation. So if you have any questions as Debbie's giving her presentation, you can put those into the question and answer icon and submit those questions. And with that, thank you for joining us today, Debbie, and I will turn it over to you.
Thank you so much, Laura, and thanks to everyone who is attending here today. First of all, Happy New Year. I hope everyone had a wonderful holiday season. It was a beautiful one here in Pittsburgh, a little snow at the beginning, followed by some warm weather at the end, but it was all good. My goal here today is to provide you with an update on where we are from a short-term markets perspective and where we think we're going, and based on, what reasoning in 2023, and ultimately what those markets then provide from a product standpoint for you as clients of the bank. So you're well aware, I think, from a Federated Hermes perspective, about 75% of our assets are in liquidity markets. So money market funds, short-term investment pools, separate accounts, offshore funds that are in that very short, 1 year and under space. And Federated's, kind of motto for decades has been that we are a franchise for all seasons. And in that regard, 2022, the key product for that franchise for all seasons was in the short end space, in the liquidity sector, in the money markets in particular. So performance in a rising rate environment with a stable value product basically was a large source of asset gathering and the only positive return basically that you could get from an asset class separation perspective in 2022. For 2023, we're expecting it to probably maybe even be a little bit better in that the franchise for all seasons will continue to emphasize the money market side of the equation, with interest rates, at 4.25 going to 5.25 in the, probably first half of 2023. Returns for the full year on money market funds are going to be fairly good. On the other hand, when you look at our other major asset classes in longer term fixed income security types, as well as equity types, they are not going to have the volatile and, disastrous years that they had in 2022. So expectations would be for 2023 to be a little bit more even keeled across the asset classes. Again, with money markets being probably the best asset gatherer and the least volatile from a return perspective. And I can tell you that I've operated over the course of many decades in the career that I've been in at interest rates that for too long were at 17 basis points, let's call it. And at the beginning part of my career, at a point in time when interest rates in the US were 17%. And what I can tell you is that neither one of those are healthy. Neither one of those are sustainable. Neither one of those are based on, good economics and, inflationary backdrops from a US perspective, and even in the more, recent decade or so from a global perspective. So where we are today is with a Fed that is very pointed at where they want to go and where they are right now and where they expect to be. What we also have, though, is a market and yield curves to some degree who don't believe them. And I was taught very early on in my career, don't fight the Fed. And I feel like all the market wants to do right now is fight the Fed. That was more difficult to do back in the 80s and the 90s when we didn't have as communicative of a Fed with as much disclosure and informational content provided to the market as we do today. Yet we still have a market that wants to fight the Fed. The Fed is telling us, through their dot plots, they're telling us through their Fed speak. This week we have Bostic, we had Kashkari, we've had Powell, several instances, continuing to emphasize getting to 5+% from a terminal rate perspective and holding there, not immediately peaking and going back down. But that is not what we're seeing from a yield curve perspective on an expectations basis. We have right now overnight rates that are in the 430 area and 1 year treasury rates at a 472. So 40 basis points. That's not what the market should be expecting. And even if that was, 70 basis points up and 30 basis points down for a net 40, it's still not what the market and what the Fed are telling us. LIBOR, on the other hand, and the credit markets, so the deposit market, the commercial paper market, corporate offerings, are offering a little bit more value and a lot of spread over that Treasury sector. 1 year right now in the mid 540s, 545, let's call it. So there you're looking at something that's over 100 basis points in expectation with some spread associated in it, obviously. And that to us looks a whole lot more reasonable. Part of what is continuing to impact in a lower yielding way the Treasury market is the dearth in supply that we've been seeing with a huge excess run up of demand, especially at year end and continuing on into this beginning of January. You know, we have a Fed outlook at this point that looks at the early February meeting for 2023 likely being 50 basis points. That's what the Fed right now is telling us. They could potentially lower it to 25 basis points. It's hard to imagine with the employment number that we got for December that would likely be the path that they take, but it could be. On the other side of the economic equation, we have seen inflationary measures come down, but they've come down from 9, 8, 6% to 5 and 4%. Not to where the Fed wants to be and is targeting, which is 2%. I'm asked the question all the time, you know, could it be that the Fed is overshooting trying to get to 2%? And will they maybe recognize that as they get closer to it, especially if there's economic, you know, pain that's being brought forth in the form of some sort of a growth slowdown or, you know, a mild recession or even worse, a more severe recession? And the answer is possibly, but that's not what they're telling us right now. So as long as you're navigating the short-term markets, listening to the Fed really seems to be what the best, you know, strategy could be at this point. So expectations of 50 basis points in February, early February. If they're not at 50, they'll be at 25 more than likely. And then we think March and May will be followed with 25 basis point additional incremental moves. And then potentially, you know, sort of a breather once they get to that 5.25% terminal rate. Now, our expectations, and I think where the market most gets this wrong, at least from what the Fed is saying they'll do right now and expects to do right now, is that what we see come March, April, May, June is not a peak that immediately starts to go down the other side from a standpoint of where the Fed is with their, you know, interest rate policy, but rather a plateau. And that plateau goes up and then it maintains it. It maintains it for some period of time that we think is through the end of 2023. So what does that mean for money market products? That actually means more asset gathering, because at that point, we've not extended duration yet. We have not extended our weighted average maturities yet. We have dabbled in and purchased 1-year securities when we thought they offered some good relative value, but not in a way that commits our portfolios to something that's longer than, you know, sort of the 20 plus day weighted average maturity. When we get to a point where we feel like the Fed is plateauing, we will extend those weighted average maturities a little ahead of time. Hopefully, you know, timing is tenuous, but hopefully we get it more right than wrong. And ultimately what that means is you pick up a spread then, because in a positive yield curve, you're extending with higher, you know, yielding securities further out the yield curve. And as such, you're picking up additional return, additional basis points into the portfolio when you do that. That happens when you approach and then plateau. So, you know, that's our reason for very positive expectations in 2023 for liquidity products and especially money market funds. So let's talk a little bit about inflation. Inflation's obviously one of the Fed's, you know, targeted mandates. They need to bring it under control. Do they need to have it at 2%? Well, that's where they say they want to have it. That's where they say is, sort of the neutral rate. But that neutral rate, I think, let's call it, let's be Johnny Depp in Pirates of the Caribbean and call it a guideline rather than a rule. And as such, I think, you've got potentially a Fed that starts once there's a little bit more pullback from an economic perspective in the overall growth rate of the economy, which won't be the fourth quarter. And quite frankly, it's probably not the first quarter either. It's probably not till the second half of 2023. But once that occurs, maybe the Fed then starts to let off the gas pedal a little bit and maybe target something that's more like 2.5%, maybe 3%, something that's more achievable. But what does that mean? That essentially means short-term rates don't need to come back down very far. When you think of where short-term rates started, they started at 0, basically 25 basis points. So they're up 400 basis points in that in the current process. And if they're up maybe another 100 basis points, let's call this a 500 basis point move. They didn't start at neutral. They started in an overly, extremely accommodative scenario based on what was going on from a shutdown, a world shutdown and a global pandemic and COVID. So with the expectations that those conditions won't return, what the Fed would return to when they normalize inflation and therefore begin to normalize rates isn't back to 25 basis points. It's not back to 0. It's back to 2, 3, 4 from an inflation perspective, which means probably interest rates that are more like 3, 4, or 5. So not a drastic fall off the 5% again, which is an extremely positive scenario from a money market product perspective. So when we look at, the various measures of inflation, Fed went from, overall inflation to maybe focusing on core inflation. Then they have moved on most recently to wage inflation. And there are various measures of looking at all of that, whether you're looking at the CPI, PCE, PPI, the ECI, there's all sorts of measures of it. And there are adjustments in there that, make some of the numbers a little bit more tenuous, a little more suspect than others. But generally what we're seeing is an out of control inflationary environment begin to come back more into control. Probably the one sector that is most sticky that will remain, and I think it's one of the reasons why the Fed is starting to look at it a little bit more closely, focus on it a little bit more closely, is wage inflation. We still have a very low unemployment rate here in the US. We also have a very low labor participation force rate. We have, job openings that outnumber in a large way those that are looking for jobs. We have job openings that, from a criterion perspective, don't match those that are looking for work. So where does that lead us? That leads us to wage inflation. Now, most recent headlines over the course of, the fourth quarter and now into the first quarter of 2023 have started to see some layoffs. You're starting to see that, trickle through in the numbers. They have started to see some changes to employment conditions. But we're not seeing that play through from a wage inflation yet standpoint. And I think to some degree, maybe it will not play through as quickly or as earnestly as it has in past cycles because of COVID, because of the capability for people to work from home, work remotely, not necessarily be in a location, in an office all the time. And, I think that brings about more competition in the job world, and that maybe keeps that wage inflationary side of the equation a little bit stickier, a little bit higher for a little bit longer. That there are some things too that are beyond the Fed's control. You've got extraneous factors like what's going on in the Russia-Ukraine war, the situation there. China in a couple different ways. It's reopening and what that's doing from an economic perspective after having, basically been closed for the last 3 years on an economic basis. But then you also have trade negotiations with China that are tenuous and still unresolved. Supply chain issues continue to abound. And because they are so tight from a supply chain perspective, you've got small things like labor stoppages, like what we have going on in the UK, what we had with the ports out in California, a year and a half ago, when a major cargo ship got stuck in the Suez Canal, things that are normally one-offs that don't have a huge impact on broad-based statistics like wage inflation and supply chain issues are in fact more consequential because of the tight nature of those. When we look at the labor force participation rate, I noted that it was at a very low, the lowest amongst developed nations at 62.3%. We're not sure when that ends. We thought it would end when, the stimulus monies stopped. That didn't happen. We thought it would end when unemployment benefits ran out. That didn't happen. There was, so it's the summertime, maybe once kids go back to school, their parents will go back to work. And that didn't happen. Now you've got, a large amount of savings that it seems as though people are working through. Maybe when those start to deplete a little bit more, that's what maybe that's the genesis for having people get back into the labor force. But I also think that, the pandemic has created some, multi-generational family trends that maybe don't force as many people back into the workforce as historically has been the case. So it's really perplexing. And I think it's something, again, that the Fed is grappling with, but not everything is within their control. Right now, what they feel they're most in control of is interest rate expectations, and, keeping inflation at a rate that's at least trend wise going in the right direction, i.e. declining. From a recessionary perspective, what are the risks? We think that at this point, a soft landing would be pretty tough to navigate. And it's not impossible. It's not a 0% chance of probability, but I probably don't give it much more than 10%. I'd call a mild or soft landing type of recession, one that has the most likelihood, probably 50-60%, somewhere in that neighborhood, but with something that's more normalized and a little bit tougher to handle from a recessionary perspective, not being out of the question either. And, that being 20, 30, maybe even 40% from a risk perspective going into 2024. I think it really depends on how the Fed handles where they feel comfortable stopping and feeling like inflation is within their bounds. Maybe not exactly at their 2% target, but within their bounds. They talked about before COVID occurred, they talked about and did raise rates 2016 to 2018 without any inflationary metrics that were over 2%. And they did that because they were operating in an inflationary model that was around a set of bounds. And those bounds were, for the most part, lower than 2%. So maybe if you go back to those bounds, the Fed can get comfortable with something that shows inflation at 3 or 3.5%, knowing that there were lower aspects and bounds at 1.5, less than 2% pre-COVID that, maybe offset those slightly higher numbers that they could potentially settle at in this overall process. So through all of this, as I said, our expectation for money market funds gross yields right now are in the mid 4%. So, 435 on a gross yield basis out to like a 455 for total taxable types of products, and 3%-ish or so for tax-free types of products. We feel like they're going to go north of 5%, get up to in the case of the government funds, and go north of 5% for prime products. some of the sectors that we like include the ABS sector, the asset-backed commercial paper sector. It's based on consumer receivables. The consumer is still the strongest part of the economy. They continue to drive retail, continue to drive, even though housing has fallen off from a mortgage rate perspective, they continue to drive that market forward. There are sectors that we're avoiding, but we think the banks go into any type of a recession that we might have at the end of 2023 or the beginning of 2024 with very strong balance sheets, very high quality metrics. So we think the financial services and banking sector in particular is well situated to handle any kind of a downturn. I think, COVID, work from home still creates unknowns. From a labor force perspective, I think we're still following that and seeing what happens in the marketplace. When we look at the municipal sector, it's quite volatile, but we do think it is fairly attractive. State and local governments are, performing well. To a large degree, they still have a lot of the stimulus monies that have not been spent that came from the federal government. There are supply-demand imbalances because of that. They don't need as much funding, so that causes some of the volatility in the overall muni market, but we still think there's good overall value there when there's enough supply. Some of the complicators or the sidetracks that we're seeing in markets today would include such things as quantitative tightening. So the Fed is buying $95 billion or allowing $95 billion worth of debt to roll off their balance sheet on a monthly basis back out into the marketplace. And, our hopes from a short-term liquidity markets and securities perspective was that if those were longer term securities rolling off, that they would be allowed to go into the repo market as collateral, increasing that size of that market, which we could then use in the money market funds, as for counterparties in the repo market. Or we were hoping that they would increase, what would be available from a treasury bills perspective, increase the supply in the short end of the market, which would help offset some of the supply demand imbalance with all of the cash that's come into the front end of the market since the Fed began increasing rates back in March of last year. That we think will continue. Unless there's some sort of a, bond market revolt to that, it certainly doesn't seem to have posed too much of a problem at this point. But where it's not really helping from a supply perspective in the money markets is in the treasury marketplace, because to some degree of what's going on with debt ceiling, debt negotiations, when we reach our limit, when, treasury has to start going into, the use of extraordinary measures, and ultimately what that means from a cash balance standpoint from a US Treasury perspective. And then when the market gauges, expectations would be that extraordinary measures run out. And certainly we at Federated Hermes don't believe there's any risk, even in the slightest way, of a technical default or a real default by the US government. It's these types of, sort of continuous pushing it to the edge before bringing it back home and making and settling it. It just causes definite market constraints. It causes certain sectors, certain months, certain dates in the treasury market and certain types of securities to be better or worse off because of what's going on there. Unfortunately, we've gotten all too used to dealing with these types of issues. Over the course of the last 10 years, they happen somewhat frequently. We feel justified in knowing that the outcome will be good, but it is frustrating when we have to deal with it in the marketplace in a way that's causing anxiety from a shareholder perspective, and maybe, making yield curves look a little bit unusual compared to what they should be looking like if you're just looking at what's happening from an economic, inflationary, and interest rate outlook perspective. So those are the complicators that we continue to follow, and watch what they, when they get settled and how they get settled, what that means then to the market. So with that, maybe I'll stop and see what questions this brought about, and if there are additional topics that you might like me to cover.
Thank you. Thank you. That was wonderful. We do have a few questions that have come in. We have a question from Mark. What do you mean by the market fighting the Fed?
Okay, so if you look at the work projection on Bloomberg, which is world interest rate projections, and it's basically showing you, based on where the Fed funds futures contracts are trading, what the expectation is that's built in when you look at where yields are offered in the market today. So what that curve is showing us is that the Fed peaks at a rate that's just under 5%. Let's call it 4.95%. And that's in June of 2023. But then it shows us, based on, again, where market rates are being offered right now, that by the end of 2023, December of 2023, that market is back down to a 448. So basically a 50 basis point decline in the second half of 2023. And that's not what the Fed is telling us. Last year, the Fed told us we're going to have higher rates, we're going to have them sooner, and we're going to have them longer. The only thing that's really changed in their messaging right now was because of the 50 basis point increase in December versus the 75 that they had, for the rest of the year, basically. And so that takes the sooner out of it. They've already done the sooner, but they've told that they're still telling us expect higher rates for longer. So longer, we don't think gets us 50 basis points less from June till December of 2023. We think the market is overlooking and not agreeing with what the Fed tells us they want to do, should do, and will do at this point.
Okay, thank you. We have another question from Tim. How would you grade the Fed?
How would I grade the Fed?
Yeah.
Well, maybe a B minus, let's just say, based on slow to react. It was really just in the fourth quarter of last year, only, a little over a year ago, that they dropped the transitory inflation phrase, so that was way too long. They held that for way too long. Now, maybe they're slow to react on the keeping it for longer perspective, but I think they're still resolute about that. They are telling us they will be data dependent, so that's good. But when you have data that is showing two different things, you've got employment that is as strong as we've ever seen it, continuing in the month of December, low labor force participation, high wages. The employment side of the equation is not a problem today. In fact, it's a strength. On the other side, you have inflation that was extremely high. Granted, it's coming down, it's going in the right direction, but still, from a standards of the last 2 decades, it remains high. And the Fed, as one of their mandates, feels like that needs to be brought under control. So it's when you've got data that is showing different paths, maybe different, methods of dealing with the issues, they have to choose a path, and they've said what their path is going to be. I think maybe to some degree they get a little stuck in that path sometimes. And so therefore, it's a passing grade, obviously, certainly on a pass-fail basis, they'd be on a pass basis, but I think they're probably a little slow on some of their decision-making processes. So let's call it a B minus.
B minus, okay. The next question we have comes from Sarah. Some are saying a recession is certain, particularly with the inverted yield curve. Your thoughts?
Certainly. We're pretty much in that camp as well at this point. I mean, I think, I noted that a soft landing will be really difficult for the Fed to navigate. Having said that, our most likely expectation of a recession is not a severe one. It's more a mild to moderate recession, that doesn't last for years on end. When you look at, the inverted yield curve, I know people focus on, the 2s to 10s part of the curve. So 2 years out to 10 years. And that's been inverted since, I think maybe the earlier part of the year, but or maybe the summertime, but we like to look at, and I think the Fed likes to look at inversion in the context of Fed funds out to the 10-year. And that really is only inverted over the course of the last maybe 2 months or so. So in that measure, the Fed is not behind. And when that inversion occurs, you're looking at something that generally is 6 to 18 months away. So, that's our reason for saying certainly not before the second half of 23 and more likely into the first half of 24. But being able to avoid it, completely is a low and diminishing expectation at this point.
Thank you. That wraps up our questions for today. Thank you again, Debbie, for the wonderful presentation, and to all of our guests, thank you for attending today. In the next few days, we will be emailing you a link to the recording today. Feel free to forward that to anybody you would like to share it with. And I also want to let you know that we have arranged for another webinar Wednesday with Federated Hermes on March 15th. And this will focus on the equity markets. So we're excited and look for that. And thank you for joining us today.
Thank you. Have a nice day.
Bye.